Welcome to another edition of Focus on Alternatives. I'll be your host today, Greg Moz, and this is a joint venture between Real Assets Advisor Magazine and ADISA. Today we have Stephen Meier with Seyfath Shaw. He's based in Chicago. We're going to be talking about opportunity funds. So Stephen, let me just start off by saying we've been hearing a lot about qualified opportunity funds. What is so special about these funds?
Thanks, Greg. Opportunity funds are a remarkable potential investment for long-term appreciation in a tax-advantaged vehicle. What they provide for is three categories of tax benefits: deferral, reduction, and elimination. I'll cover each of them. So a person, an investor who has gains, capital gains from any source, not just real estate, but stock sold on the market, can invest the gain amount into an opportunity fund and defer tax on that gain for as long as they hold that investment or until December 31, 2026. The statute also provides for some reduction of tax in that case, and that is that even though the tax on the gain invested will ultimately have to be paid, if that investment is made before December 31, 2019, a 15% reduction in that tax is available, and if that investment is made before December 31, 2021, a 10% reduction in tax is available for persons who stay in the investment until at least December 31, 2026. But the real benefit, tax advantage with an opportunity zone investment lies in the third piece, which is the elimination. And that is that a opportunity zone investor who invests in an opportunity zone fund and holds that investment for at least 10 years will, when they dispose of that investment, get a basis step up equal to the fair market value of that investment when they dispose of it. So in other words, there will be no tax of any kind upon that disposition. It functions a lot like the step up in basis that heirs get in assets inherited through the decedent. And in that sense, it's a lot like death without dying for OZ investors. It's an amazing opportunity for capital growth and appreciation in a long-term investment with significant tax advantages.
Thank you for walking us through that. And with those extra tax advantages, people are going to be rushing to get in sooner rather than later. So what kind of investments can investors access in these qualified opportunity funds?
There are quite a number of different possibilities here, but I'll focus on a couple of dimensions that I think are important for an opportunity zone investment. The first is that the statute is written in a way to really encourage, and the point of the statute is to create the incentive to develop new property, new investments. And so what needs to happen with respect to the assets held by an opportunity zone fund is that they need to be new assets, original use assets, or they need to be substantially modified assets. So in other words, it's not enough to simply buy a pre-existing investment, real estate investment, and hold it. A person needs to, a fund sponsor will need to go find property, either requiring substantial rehabilitation or vacant land, and put new property on it or substantially improve the property that's there in order to qualify for the opportunity zone investment benefits. Specifically to that point, with respect to buying property with a building on it for rehabilitation, the rules require that whatever the purchase price is allocated to that building, at least that amount plus another dollar, at least that amount would need to be invested in that property in order to qualify as a good opportunity zone investment. The second dimension that I want to talk about is the fact that the opportunity zone fund needs to be engaged in a trader business. And so what's important here is that the underlying investment needs to be a real operating asset in which the fund, the managers have to have some meaningful day-to-day operational responsibility for. So in other words, I don't believe, and I think most of my colleagues on the tax bar would agree, that at least with the rules currently in place, that a triple net leased property would be a good investment for an opportunity fund, but an actively managed multifamily real estate project, a hospitality project, a actively managed piece of self-storage real estate, those would be examples of good assets for opportunity zone purposes.
Thank you for walking us through that. So there are literally dozens of funds that have been announced here in the last, couple of months. How should an investor or their financial advisor be evaluating these funds as a potential home for their capital?
Yeah, thanks, Greg. Well, we're going to talk a little bit in a moment about some of the nuances and clarifications that have been provided for in the proposed regulations that were issued in October 19th of a couple of weeks ago. But I think you've seen it, I've seen it, a number of audacious plans promulgated for multi-billion-dollar opportunity zone funds. But I think from an investor's perspective, that's all really interesting, but a lot of smoke without much fire. The rules that are in place even before the proposed regs came out made it clear that in order to qualify as a good opportunity zone investment, the investment made in the fund, the cash raised by the fund, needed to be deployed in opportunity zone property, which cash is not, at least twice a year, measured on 2 measurement dates. The proposed regs, which we'll talk about in a second, provided for a safe harbor around a certain way to deploy that capital. But the short answer is that absent a specific plan with respect to redevelopment or creation of new investment property that is specifically related to the investment being made and the capital being raised, that the fund without those specifics really doesn't have a plan for qualification. And if I'm an investor, I want to be looking for an opportunity zone fund that has a well thought out specific capital raising and deployment plan for a specific project that I understand and that makes sense absent the tax benefits. I think with all of that, that's the kind of investment that as an investor I would be interested in. I mean, these are low-income community investments. Not all opportunity zones and not all opportunity zone opportunities are going to be created equal. And so each one needs to be evaluated on its own independently in order for an investor, I think, to make an intelligent investment decision regarding where it's putting its money.
I really like what you said there, where you talk about making the investment based on the merits of the investment, regardless of the tax benefits that come along with it. I think that's a really important point to drive home. But you also mentioned, that some of these are hundreds of millions or billion-dollar funds opportunities. What happens if a sponsor puts together a fund and a plan isn't able to raise enough capital? And I mean, let's say they raised 25% of the capital, but not 100%. How is that going to affect that fund and those investors?
Well, so I think this might be a good point to talk about really one of the key elements of the proposed regulations that I think clarified, at least from a qualification perspective, a pathway that fund sponsors can have in order to actually move forward with their opportunity fund planning. And that really, the key element in those regs, in my mind, was the working capital on-ramp. Pursuant to the working capital on-ramp, up until the proposed regs, I think most sponsors were struggling with, as I mentioned earlier, how to satisfy the fairly onerous asset tests that apply to opportunity funds, specifically referring to the 90% asset test that on 2 measurement dates each year, an opportunity fund needed to be invested at least 90% of its assets in opportunity zone property, and cash does not qualify as such for the most part. So in other words, as an opportunity fund raised money, it needed to be able to put 90% of that money in effect into good property such that it was continuously qualifying as an opportunity fund. What the proposed regs have given us is a working capital on-ramp that provides that with respect to a proposed capital raise, so long as there's a written plan that specifies how much capital is being raised and is needed, so long as that plan is specific with respect to the use of that raised capital, and so long as the plan is actually effectuated in substantially consistent with the written plan provided, that would allow a opportunity fund to raise all the capital that it needs, that it's called for in its written plan, and deploy it over a 31-month time frame without needing to worry about satisfying the various asset tests that apply to opportunity funds. So, in other words, when a sponsor has a specific written plan with a specific capital deployment schedule and substantially complies with that plan, it can raise all the money it needs on day one and deploy it over a 31-month period without concern for violating the opportunity fund rules. So, it's going back to your question then, I think the real touchstone here is what's the plan and how much money have I raised as a fund manager relative to that plan, and is that plan realistic? But the answer, I think, is that if you can raise the funds that your plan for a project calls for, then I think you can raise that money and deploy it and be confident that you can satisfy the test and that your investors will be in a good position relative to satisfaction of the tax qualification of that fund.
Okay, thank you for walking us through that. So this is a brand new investment. The IRS just came out with some additional regulations around it. So what answers did the IRS give us? And then, what's still uncertain that we need to figure out when it comes to these opportunity zones?
Yeah, I think I can break this into two real dimensions here. The first deals with qualification of a fund, and then the second would deal with the operations of a fund. I think around qualification issues, we have enough information to be able to effectuate real opportunity fund planning and creation. We now know, for example, like I just spoke about, we now have a working capital on-ramp rule. We now know, for example, the types of gains that an opportunity fund can receive, and it can receive capital gains. They can be short-term or long-term capital gains, but the view right now is that depreciation recapture doesn't, for example, count as a capital gain because depreciation recapture is statutorily converted into ordinary income. So we know what kind of gains. We have a roadmap for capital deployment and a safe harbor for that. We know what kinds of entities can be involved. There was a concern that it was only for literal state law partnerships and corporations, but it was made clear in the proposed regs that really is a tax qualification issue, and so limited liability companies can be used, as well as partnerships and corporations. So we've got clarity on those key issues and many others around qualification issues, and that's important. Operationally, I think there's still some uncertainty, and that's going to come into clearer focus over time, and additional proposed regs, I should say, are expected to be issued early next year. But probably one of the more important issues there really relates to the allocation of non-recourse debt to a fund investor for which the fund is a partnership for tax purposes. There was a lot of concern before the proposed regs came out about how allocated debt might be treated as a separate investment by OZ investors. The regs clarified that that's not true and helpfully signaled that, in fact, it seems that debt allocations and other general tax law rules will apply to OZ investors and non-OZ investors consistently, and that would be a good thing to know. Again, it's an operational issue, but that would be an important thing to know, since I think most of these funds, at least as I've thought about them, would contemplate some development phase, a stabilization, and commonly a finance into permanent debt at stabilization of the asset, and which might give rise to the possibility of distribution of debt finance proceeds to the investors. And so without, if the additional proposed regs confirm, as I believe they will, given the signal provided for in the proposed regs that we already have on not treating allocated debt as an additional investment in an opportunity fund, I think what we'll have is the ability through allocations of non-recourse debt, through vertical slice guarantees as needed, to ensure that OZ investors can get themselves sufficient debt allocated to themselves for basis creation purposes, such that cash could come out to investors on a non-tax basis, and if that's true, that would be a very powerful tool.
No, so it's going to take the coordination on the financing side, and that makes a lot of sense. That's going to be critical to making these funds come together. So qualified opportunity funds, it's the first real tax vehicle or new vehicle for tax advantage investments, kind of since the Delaware Statutory Trust for syndicated 1031 programs. But what are the kind of advantages and disadvantages of opportunity funds or qualified opportunity funds relative to Section 1031?
That's an excellent question. I think that's what's frankly on a lot of people's minds. So advantages of opportunity zones over 1031 programs would include the following. 1031s are now, since the new tax law at the end of 2017, limited to real estate only, deferring gain from real estate and reinvesting those gains in a 1031 exchange. The opportunity zone rules do not have that limit, and any kind of gain, as long as it's capital gain, can be invested and take advantage of the opportunity zone rules. There's a compliance advantage for opportunity zones and their investors. 1031 exchanges have elaborate qualification requirements, including tracing of cash, reinvestment of all the entire investment in new property, the use of qualified intermediaries and the like, and specific identification periods, including 45 days after sale to identify replacement property, and another 135 for a total of 180 to acquire the replacement property. For opportunity zones, on the other hand, there's no tracing, no qualified intermediary. Simply, the investor needs to invest an amount of cash equal to the gain that investor had within 180 days into the qualified opportunity zone fund, and make an election that it has done so. And with all of that, then they have satisfied the requirement to designate cash that goes into the fund. The third area is that the 1031 exchange programs tend to require, and the rules around them really tend to require, that the assets that they hold be very passive, in fact, almost go to the point of forbidding any sort of redevelopment or repositioning play with respect to those assets. The opportunity zone investments, on the other hand, are really the opposite. They require the fund to be actively engaged in the business of operating and managing the property that it owns. They require a significant transformation of the property that the opportunity zone initially buys, either through the creation of new property or the substantial improvement of property that it buys, which requires the investment of purchase price plus another dollar in order to satisfy that. So I think on those three issues, opportunity zone investments are superior, arguably, to 1031 investments. But 1031s do have advantages over opportunity zones. I think the key one is that the gain that is invested in an opportunity zone fund, the tax on that gain will need to be paid. It'll need to be paid when the investment is sold, if it's sold before December 31, 2026, or it'll spring on December 31, 2026. So unlike in the 1031 exchange, where an investor can dispose of real estate, reinvest in new real estate, and do that ad infinitum until they pass away, an opportunity zone investment, that gain that is invested in that fund, the tax on that will need to be paid. Second thing is that 1031 programs, can be that they have real estate everywhere. They have investments in some of the best locations in the country, some of the best opportunities for a stable real estate investment and ownership are available to 1031 investors. I mean, the truth of the matter is, the opportunity zone rules create a very powerful tool for potential investment appreciation in a tax-advantaged manner, but these investments need to be made in designated low-income communities. And as a result, I think everybody needs to be aware and mindful of the fact that these investments will carry typically more risk than a investment made in a non-opportunity zone designated location. I mean, that's really, those I think are the key, advantages and disadvantages of the opportunity zone rules and 1031 relative to each other.
So I think that you brought up a very interesting point there at the end regarding the risks and just by the nature of where the real estate is located and its purpose. So I hope everybody understands that, and they need to think about how they mitigate that risk or get comfortable with that risk. I do want to go back to one of the things that you said there. You said any gain, not just real estate, can go into the Opportunity Zone Fund. Other than real estate gains, what are other examples of gains that can be rolled in?
Well, I think, for example, gains from the sale of publicly traded stock, gains from the sale of Bitcoin or other financial technology products. There are lots of gains from the sale of artworks. Corporate gains from the disposition of businesses. I mean, there's a lot of potential opportunity here. You've probably heard about the recent designation, for example, by Amazon of 2 locations in the U.S. where it's going to sort of co-place its second headquarters in Crystal City, Arlington, Virginia, and in Long Island City, New York. Everybody should know that Long Island City location is right across the street from a public housing project and, in fact, is in an opportunity zone. So Amazon is taking advantage by plowing whatever corporate gain it has into that project and is going to be able to take advantage of the opportunity zone rules as a result.
Fascinating. So this is new. What do you think the future of qualified opportunity funds are?
Well, so we've got, again, the announcements of various funds that look a lot like blind pool funds, which really don't seem very feasible, at least as presented by the sort of high-level short announcements that we've seen. But I do know that there are a number of sponsors working through some clearly defined project-based investments that will be launched as opportunity funds. I mean, I think there is a significant amount of potential. I think there's a high level of interest because the ideal scenario for an investment like this is simply that it's an investment with significant upside and that could eliminate all taxes on any appreciation in the value of the asset, other than paying the gain that you tax on the gain that you invested in the project. But I think the reality is that while there are a lot of announcements around opportunity zone funds, there's really going to be, I think, a realization, if there hasn't been one already. I know a lot of folks that I've talked to understand this, that there's going to be significant constraints around investment opportunities. This is not only do you have to plan and be thoughtful about how you do the development, where you do it. There are really probably not as many as you need to fill up every $5 billion fund that's been announced. Not enough real, shovel-ready projects out there to satisfy that level of demand. Now, I know that there are some sponsors out there who've lined up a number of very good opportunities, and you're going to be seeing them come out in the coming days and weeks. But I'm not sure that we're going to be seeing all of these $5 billion funds filled up with assets and investors in the short term. I think what's going to happen practically is there are going to be a number, probably a handful of funds that will come out in the coming months. I think a lot of folks will, who are thinking about launching funds but are still a little timid about it, are going to sit on the sidelines, see what the market reception is to those funds, and then after that has been those initial funds, that first wave, let's say, have been digested and evaluated. I think that's when the real sort of wave of opportunity fund projects will come into play. I mean, that will align with the time needed between now and then to actually line up those projects, and it'll align with the time frame in which those initial funds will be market tested, evaluated, investors will be in them, and an initial appreciation of how they work will be made.
Great. Thank you for walking us through that. And it sounds to me like the typical ways that you evaluate a sponsor in a project still apply here. What is their track record? What's the identified property? Do they have it under contract? Are they going to how detailed is their plan? So it's good to see that all these things are lining up and the traditional ways of evaluating investments can be applied here. So Stephen, thank you so much for joining us today and walking us through these details. And to our audience, thank you all for listening. For more information about alternative investments and qualified opportunity funds, please visit realassets.advisor.com or adisa.org. Thank you.